Hi, I'm Peter Jones, Chartered Surveyor, author and property investor. Question I'm sometimes asked is, Peter, what is the ideal amount of loan to value to have spread across a portfolio or even on an individual property? And how would you know what that figure is? Well, it's an interesting question, and I have to say that in my opinion, there are no hard and fast rules on this, and a lot of this is going to depend upon what it is you're trying to achieve. It's going to depend upon your current circumstances. It might even depend on something like your age. Let me explain what I mean by that. Well, first of all, let's just think about what loan to value means. Loan to value is essentially the amount that a bank are going to lend you against the value or the purchase price of the property. Remember, if it's purchase price or value, it's going to be the lower of the two. It's possible that as you hold properties and you build your portfolio in future years, you may want to refinance, and so your loan to value will be changing on the property, or at least the loan to value may stay the same, but the amount that you borrow against the property may increase as values increase. A typical buy-to-let lender is going to lend you 75% loan to value. If it's a more expensive property, they'll start to pare that back. So for a more expensive property, you may find that you can only borrow 65 or 60. There are some lenders out there who will lend 80% or even 85% loan to value. Now, when I first started, I was very aggressive. I was trying to get the maximum amount of money out of my portfolio all the time. Why? Because I wanted to build a big portfolio which is going to give me decent cash flow. Now, one of the ironies is that the more you borrow, the more it impedes your cash flow because you're paying more mortgage interest because you're borrowing more money. But on the other side of the equation, the more money you take out, the more money you've got, which you can use for deposits on other purchases. And so you've got to balance the figures, do your maths, see how it works out. But I came to the conclusion it was better to get the money out, as much money out of the portfolio as I could, so that I could buy more and more properties. And because I was being very aggressive about it, whenever I could, I was using an 85% loan to value product. That worked well for me. Now, the argument against that is, well, what if something happens like there's another credit crunch? What if the property market crashes? What if values fall? Well, it's not an if, it's going to happen. I don't know when, you don't know when, nobody actually knows when. We haven't got crystal balls, we can all have our own opinion of when it's going to happen, but of course the market is going to fall. But in my experience, from what we've seen so far, and history tends to repeat, but we can't always assume that history will repeat, but from what we've seen so far, property values tend not to fall as much as people always assume they might when they're worrying about this kind of thing. Even in 2007, I think if you look at the overall average figures for the UK property market, did it touch 20%? Now, in some areas it was slightly more than that, but in some areas it was slightly less than that. And of course, over time, what we've seen from history is whenever there is a crash, there's a recovery. Why is that? Well, because the fundamentals which drive the property market don't change even when there's a crash. And also the Bank of England are charged with creating an inflationary economy, for example. So all of these things work in our favour. So if you go through and you look at if you look at the different house price indices going back to the beginning, you'll see that there are peaks and there are troughs. There's points where the market's booming, there's points when the market's crashing. But the overall trend is up. And it's up because of the inflationary pressures and the pressures on the property market anyway. So even if the property market crashes, we can assume that at some point it's going to come back. So the big question is, can you sustain yourself while you're waiting for the market to come back? If you can, and if the cash flow is sufficient to keep paying the mortgage interest on the properties, then the loan to value amount is almost irrelevant. It only becomes an issue then if you have to sell. If the property market has crashed by 25%, and you took out an 85% loan to value product, then clearly you're going to be selling at a deficit. That is going to hurt. That's only going to be a problem though if you have to sell. So the key thing is to think about your circumstances, look at where we are in the economic cycle as you're watching this video, because you might be watching this video 5 years after I recorded, 10 years after I recorded. The internet's an amazing thing, I'm here forever. So think about what's happening in the market at the time. Think about what your aspirations and your goals are. If you're younger, you may take a more robust view because you may think, well, I'm only 30 and I'm going to be in property till I'm at least 70 or 80, so I've got 50 years to ride this out. So even if there's a fall in 10 years, I've then got another 40 years to watch the recovery. If you're currently in your 60s or 70s and you're trying to build a nest egg for your retirement, then maybe you want to take a more cautious view and you may be thinking about, I'll have a lower loan to value amount. So is there a right or wrong answer? No, I hear learned people saying that a good point to get to is to have to say a 60% loan to value across your whole portfolio. That's fine if you're at the stage where you can sustain that, but if you are young and more ambitious, you may want to say, well, actually, I want to be more aggressive than that. If you're older, you may say that's the point I'm aiming for. It's very personal, it's down to you. So I hope you found this maybe thought-provoking, educational, informative, inspirational. If you did, then please don't forget to subscribe, like or follow. There's usually a button down here which you can click depending on which platform you're on, where you can like, follow, subscribe, and we can keep in touch, and then I can send you even more great property investing content. Well, I hope you found that informative and inspirational. And if you want help in property, please do come over to my website, www.thepropertyteacher.co.uk. Loads of great resources there, including my blog. There's loads of free videos, loads of great articles. There's free reports to download, including Learning with Peter, where you'll be able to access resources like my video courses, like my ebooks, including my home study course, the Successful Property Investors Strategy Workshop, which I've literally sold thousands of copies of, which takes you through how I started in property, literally with none of my own money, but how I was able to build a portfolio of £2 million worth of property in just 4 years. I'll show you everything that I did right so that you can do the same, and I'll show you everything that I did wrong. I'll tell you about all of my mistakes so that you can avoid them, so that you can progress in property far more quickly than me. Until next time, here's to successful property investing.